us on the housing front. Ivy Zelman, CEO of housing research firm Zelman and Associates. Great to see you, Ivy. Thanks so much for joining us. I mean, first of all, a big picture question. We've been talking all show about the way the market has cooled off to start the year, the stock market, and pulled back year to date. Is that going to happen at some point for the housing market in the year ahead?
We think the housing market, which is extremely strong right now, is definitely set to moderate as we continue to see interest rates moving higher, married that with more supply coming to the market. And supply has really been the lack of supply has really been what I think has been a key driver and allowing for very strong momentum that's continued.
Which regions or price points in particular are most ripe for correction?
Well, we actually just published our proprietary home building survey for December. It was the 6th consecutive month of seasonally better than expected order activity on a normal sequential basis. So it was better than normal. And it was really across all price points. We're seeing definite strength continuing at entry level, but really throughout all the price points, with luxury seeing a disproportionate increase, which is really being driven by second home purchases. And we also are seeing a lot of investor purchases, non-primary buyers in the market.
Square that view, Ivy, with what we got from KB Home. The stock rocketed higher today after the company painted a pretty optimistic picture for housing demand.
I think that the builder community in general is very optimistic given the backdrop, what they currently see today. And I think that what we appreciate is that the last 2 years has really been unprecedented, whether you talk about the stimulus that the federal government provided, excess unemployment benefits, a lot of the typical types of factors that have been held up, like foreclosures and eviction moratoriums, and just any kind of appreciation for the amount of free capital that's really been driving the market. I think the incremental buyer right now is really more a non-primary buyer. And therefore, when you look at interest rates rising, especially the number of homeowners in the United States that are locked in below 4%, which is roughly 70%, I think that really starts to disincentivize those homeowners to move unless there's a great arbitrage that they're, one of the 1% or the very affluent that can move from, let's say, New York to Miami or California to Texas or Boise, Idaho. I think that the bread and butter of the United States, affordability is very pressured right now, with the monthly payment up pre the rate increase that we've just seen, which is roughly 25 basis points. The monthly payment for an entry-level buyer at the end of the fourth quarter was up 17%. So we are seeing affordability concerns mounting, but I think that the real risk is that if rates were to go even as much as 50 to 75 basis points higher from here, we could see the market materially slow down.